This song is inevitable.
Yes, indeed. I expected him to play it. Thank you, Paul Brennan. We've heard several guests actually come on and liken the market environment to 1999. Our next guest says there are similarities and differences to the market environment back in 1999. Let's find out what it all means. Adam Strauss is with us, co-CEO and portfolio manager at Appleseed Capital, based in Chicago in our Bloomberg 1130 studio. You were escaping the snow, right? Aren't they expecting like 10 inches or something?
There's going to be a huge storm this week. I'm glad to be gone.
All right. Well, it's good to have you here. Tell us 1999, right? We hear this often. Tell us what's similar, what's different.
Sure. Well, let me start with the similarities. So, in 1999, stocks were at a valuation level that was unprecedentedly high. Today, the only period where stock market valuations are higher was back in 1999. So, in both situations, you've got a very expensive stock market. That's number one. Number two, the economic expansion is long in the tooth. In 1999, you were 8 years in. This year, we're about 9 years in. So another similarity. Also, in 1999, you had oil prices up significantly off the low and gradually increasing interest rates. Same thing here. You've got oil prices dramatically up the low and also gradually increasing interest rates. Another remarkable similarity is the euphoria around technology. Back then, it was the internet and .com stocks. Today, it's cryptocurrencies and blockchain. And finally, the big similarity is that anybody who there's a dramatic penalty for risk aversion. Mm-hmm. The returns that you can get by taking on the most risky assets available, and the difference between that return and avoiding risk has just been very dramatic, both recently or until a week ago, and also back in 1999.
FOMO. Well, we've been calling it all FOMO, right? Fear of missing out, Corey.
But I mean, all right. Let's take some of that apart.
But I want to get to the differences.
And I want to get that too. I promise.
Okay.
So let's start with I don't think you can. I was here in 1999 in San Francisco. There were a lot of ice sculptures. There were a lot of launch parties, but there were a lot of IPOs. There were a lot of big startups, multi-billion-dollar startups all around .com technologies. Some of them went away. Most of them went away. But there were well over 100 stocks listed. Bitcoin is nowhere near. Blockchain is nowhere near that size.
Well,
right now.
That's true. Although there are, as you mentioned, there certainly are differences. The Bitcoin euphoria, though, is not focused on companies and IPOs. It's focused on coins and ICOs. So that's
a fair point.
It's not a complete analogy.
I would say it's still not as big, but no, that's interesting.
And I also don't. I agree with you, Corey, that I feel like retail investors were kind of getting all in the .com era. Everybody wanted to kind of be a piece of the internet craze. Bitcoin, I feel like it's more selective, although you're seeing more and more interest among retail investors. Do you know what I mean?
Yeah. It's. I mean, I think that. It's a little bit different, and that goes to some of the differences that I wanted to get to.
Okay, let's go to the differences.
So the differences in general are related to, in my view, the dramatically weakened financial position of the United States, which are attributable to a number of factors. One of those factors is aging demographics. I mean, today you've got 10,000 baby boomers that are retiring and collecting Social Security and Medicare every day. And so their inclination to bet on risky assets is going to be lower, having nothing to do with the stock market and everything to do with their age and stage of life. But it's also having an impact on the fiscal position of the United States. Other differences are absolute debt levels, and I'm not just talking about government debt, but also consumer debt and corporate debt. 348% compared to GDP today versus 241% back in 1999. You've got interest rates that are lower, so that allows us to handle that amount of debt for now. And then finally, the big difference is that inequality is much greater today, wealth and income inequality, which is creating all kinds of social strife and in addition to populist politics.
Adam, we've got about 40 seconds left here. So sum it up. So what does it mean then for where the markets, the economy, where things go from here? Just quickly.
Well, I'm not going to make a short-term call, but what I would say is I think it makes sense to, I do think that now is not the time to be going after the riskiest assets. Just like 2000 was not the time to be going after the riskiest assets. I think it pays to take some risk off the table. I also think it's a good idea to make investments in areas that could benefit from a weakened dollar. And so those are some of the areas that we're investing in right now.
Okay. So that would be, for example, just real quickly.
For example, like we really like South Korea. We own several stocks in South Korea. We own a bunch of industrials and commodity-related companies that were hurt in 2015 when the dollar rose.
Interesting things to think about. Adam, thank you.
Thank you.
Adam Strauss, co-CEO, portfolio manager, Appleseed Capital, based in Chicago, in our New York studio.